Today, are central banks changing their tune? The DFA Daily to the 24th of June 2020. Hello again, I'm Martin North from Digital Finance Analytics. One of the latest posts covering finance and problem news with a distinctively Australian flavour and with a touch of philosophy on the side. In today's post, we consider whether central banks are changing their tunes, the problem of the mortgage repayment cliff, stressed landlords, and how Australians are being scammed. The new governor at the Bank of England wrote an interesting opinion piece for Bloomberg, in which he warns that the central bank's quantitative easing program cannot be seen as a permanent fixture. The COVID crisis, he said, has required strong and prompt action by central banks, consistent with their mandates. In March, disorderly conditions reached the core financial markets, posing a real threat to the stability of the financial system, by far the most serious threat since the global financial crisis. Underlying this disorder in markets was an economic downturn almost unprecedented in both scale and pace. The response has included a major program of ASIC purchases and lending by central banks with a corresponding growth of balance sheets. This has been the right thing to do to reduce borrowing costs, boost cash flows, and more broadly support economies, and it has shown how essential it is to have truly independent central bankers. But the financial system mustn't become reliant on these extraordinary levels of reserves, he said. Central banks have been able to meet their objectives of monetary and financial stability and support the well-being of citizens through the crisis so far by performing two vital functions in recent months. First, they helped counteract the economic and market turmoil. Among other consequences, the COVID crisis could have led to the emergence of risk premiums in financial markets, which could have elevated the cost of borrowing well beyond levels consistent with the monetary and financial stability goals of central banks. The fact that the predominant borrowers in this emergency are governments, reflecting the essential role of the state in such a crisis, makes no difference to the underlying economics or the importance of keeping borrowing costs in line with objectives. Then it's worth remembering that the reform of the financial system since the last crisis has meant that banks are in a position to support households and companies through this emergency, acting to absorb the shock rather than amplifying it. Second, central banks have acted as a buffer to underpin the functioning of financial markets by enabling the creation of reserves to meet surges in demand for high-quality liquid assets in stress conditions. Absent this, we may well have seen a spiralling into disorderly market conditions. As our economies start to reopen, there are three crucial issues for central banks that have become apparent during the pandemic. The first is institutional. Effective economic policy requires well-defined and strong institutions which are transparent and accountable. Independent central banks are an important part of this institutional structure. Far from calling into question or suspending that independence, this episode has called for a response from central banks. That's only possible because their independence gives them the freedom to operate. As a result, they've made big decisions and implemented them rapidly in the face of an unparalleled crisis, coordinating with governments to maximise policy effectiveness. This capacity to act must be reinforced and not mistakenly called into question, he said. Second is the role of the central bank balance sheet. Central banks deployed a range of balance sheet tools at pace and scale as the crisis developed. Reserves, the deposits held at central banks, are the ultimate liquid assets. By acting as a buffer to meet the demand for greater liquidity in the face of a loss of economic confidence, as well as transmitting decisions on monetary policy, reserves can help prevent a problem of liquidity in markets becoming one of solvency in the wider economy. But the role of central bank reserves shouldn't always be taken for granted. Rather than having to keep relying on central bank support for all aspects of the financial system, we need a robust assessment of the latter's weaknesses, the role of money market funds, and the risks to financial markets that they posed at the height of the disorder are one area to examine. And finally, the current scale of central bank reserves mustn't become a permanent feature. As economies recover, it's likely that some of the exceptional monetary stimulus will need to be withdrawn, including by reducing reserves. This wouldn't take us back to very low levels of reserves before the financial crisis, which sometimes fail to recognise the role they play in ensuring the stability of the financial system, but elevated balance sheets could limit the room for manoeuvre in future emergencies. When the time comes to withdraw monetary stimulus, in my opinion, it may be better to consider adjusting the level of reserves first without waiting to raise interest rates on a sustained basis. Now that's a very important statement, because he's suggesting that they might start decreasing their reserves before interest rates are changed. And that is a fundamental shift in doctrine which could have significant implications. Meanwhile, in Australia, the mortgage repayment cliff is very real, given the 485,000 mortgages valued at $175 billion that have been deferred for 6 months by Australia's banks, and that represents about 1 in 14 borrowers, as the ABA reported. Now, we know that the Prudential Regulator and the banking industry are in deep discussions about cushioning the impact of the nation's looming financial cliff by trading a longer period of loan deferrals for extended capital relief. Negotiations are considered likely to bear fruit before the end of July, after the Australian Prudential Regulatory Authority gathers more data from the banks conducting check-ins with customers 3 months after loan deferrals began in mid-March. Other solutions will be examined, like strengthening the term of the loan, using redraw facilities, refinancing at a lower rate, or interest-only repayments. APRA Chairman Wayne Byers told a Senate committee last month that some bank customers would clearly be unable to repay their loans once their repayment deferrals expired. But equally, we don't want to put pressure on a large group of customers at the wrong point in the cycle, he said. We often talk of the cliff, which is when everything ends in 6 months' time. No one has an interest in going off the cliff, so we have to work out what the next phase is going to be, and that will be dependent on the economic situation at the time. And Melbourne landlords are struggling under the burden of reduced rent payments and finding tenants during the pandemic. Self-retired fundees without access to the pension are notably slipping through the cracks, with many of them reliant on rental income to cover their premises. Many are looking for cheaper property managers to shift their investments to because of lost income and rent cuts, one estate manager said. Some are going to suffer long into the future. Everyone ignores that there are average, hard-working landlords that are not rich and have to work tirelessly, saving and sacrificing to not become a financial taxpayer burden as they age. We need to encourage investors to become residential landlords and provide a housing service society needs. Or, in my view, property investors are now waking up to the fact that actually property investing is a risk business, not a certain wealth-generating activity. That is a fundamental change, and it will, I think, change the property landscape forever. Now, the Bank of Queensland has informed brokers that it has reduced its maximum loan-to-value ratio for owner-occupied lending with capitalised lenders' mortgage insurance from 98% to 95%. The group-wide changes, including Virgin Money, will apply to all new applications received from Tuesday the 23rd of June and for expired loan approvals. BOQ specialist products, however, which provide medical professionals with loans with an LVR up to 100%, are exempt from the policy revision. Bank of Queensland told Mortgage Business that the bank's decision was designed to reflect current market conditions along with a range of other factors to ensure its credit policies are appropriate to the current operating environment. Last month, BOQ also tightened its income verification requirements in response to uncertainty in the labour market off the back of lockdown measures imposed to curb the spread of the virus. Such changes include temporary limits on acceptable non-PAYG income types, enhanced requirements for PAYG and self-employed income validation. Several lenders across both the non-bank and ADI space have reduced their risk appetites in recent months in response to the economic fallout from the virus. Analysts, including Moody's Vice President and Senior Credit Officer Alan Chen, continue to forecast a sharp rise in credit losses over the coming months, particularly once mortgage deferral periods expire in September. However, some credit providers, including non-bank lenders Bluestone, have rolled back some of their restrictions in recent weeks. After hiking credit rates, withdrawing its lien on credit products, and reducing cash-out limits in March, Bluestone revealed last week that it would lift such measures and reduce rates by between 10 and 110 basis points. This came amid renewed optimism from the Reserve Bank of Australia, which stated that an economic recovery may be nearer than initially anticipated amid the easing of lockdown restrictions. It was possible that the downturn would be shallower than earlier expected, the RBA noted in minutes from its monetary policy meeting back in June. The rate of new infections has declined significantly, and some restrictions have been eased earlier than had previously been thought likely. However, the Reserve Bank warned that the outlook remained uncertain, with the pandemic likely to have longer-lasting effects on the economy. And the Council of Financial Regulators, the Council, is the coordinating body for Australia's main financial regulatory agencies. There are 4 members: the Australian Prudential Regulatory Authority, the Australian Securities and Investment Commission, the Australian Treasury, and the Reserve Bank of Australia. So much for the independence of the RBA, one might say. The Reserve Bank Governor chairs the Council, and the RBA provides secretariat support. It is a non-statutory body without regulatory or policy decision-making powers. These powers reside with its members. The Council's objectives are to promote stability in the Australian financial system and support effective and efficient regulation by Australia's financial regulatory agencies. In doing so, the Council recognises the benefits of a competitive, efficient and fair financial system. The Council operates as a forum for cooperation and coordination among member agencies. It meets each quarter, or more often if required. And the Council of Financial Regulators held its regular quarterly meeting on Friday the 19th of June. The Australian Treasury attended for part of the meeting. The Council has been meeting more frequently over the past several months and will continue to do so as required. The Council's discussion focused on the ongoing coordinated response to the coronavirus crisis. The virus and the measures taken to contain it have resulted in the Australian economy experiencing its biggest economic contraction since the 1930s. However, the rate of new infections has declined sharply in Australia, and restrictions have been eased in many parts of the country earlier than was previously thought likely. As a result, economic activity is now beginning to recover in some sectors. Conditions in financial markets, internationally and in Australia, have improved after a period of significant disruption in the early stages of the pandemic. The ongoing coordinated response of governments, central banks, regulators and the private sector is working and will help to support the recovery ahead. However, the outlook, including the nature and speed of the expected recovery, remains uncertain, and the pandemic is likely to have long-lasting effects both in Australia and abroad. The financial sector, they say, has played an important role in helping to cushion the effects of the shutdown on households and businesses, and will be equally important in supporting the economic recovery. Financial institutions have entered this period with a high level of resilience, and in the period ahead, they will continue to experience the flow-on effects of the stress experienced by businesses and households. Council members discussed the importance of the transition as the economy recovers, and support measures including temporary loan repayment deferrals begin to unwind later in 2020. Members agreed that financial institutions, regulators and governments will need to continue to show flexibility in order to support the objectives of economic recovery, resilience in financial institutions and fair household and business outcomes. Council members also discussed APRA's latest stress testing analysis, which is providing insights into the possible effects of a range of economic scenarios on ADI's capital. The stress testing analysis will assist APRA in considering its supervisory approach in the period ahead. Members stressed the importance of the continued flow of credit for the recovery of the economy, and APRA has reiterated that the large capital buffers above regulatory minimums that were built up in more favourable times ought to be used during this extreme shock. Members encouraged institutions to make use of their capital buffers to continue to support businesses and households. In addition to domestic developments, Council members discussed the risks in the global financial system that are being reviewed in international forums. These include the ability of investment funds to effectively manage liquidity risk, the build-up of corporate debt in some economies, non-financial firm solvency risks, the structurally low level of profits in some banking systems, potential stress in US dollar funding markets, and the ability of market participants and financial market infrastructures to manage evolving counterparty risks. Members agreed to continue to monitor these developments closely, given the potential implications for the Australian financial system. And the Council also held its annual meeting with other Commonwealth regulators of the financial sector. These include representatives from the ACCC, the ATO, and AUSTRAC. Discussions focused on the COVID-19 pandemic and covered the responses of regulatory agencies to the pandemic, the role of financial sector competition in supporting economic recovery, and the operational resilience of regulated entities. Participants noted that extensive cooperation between agencies had been critical to the successful delivery of a number of COVID-related initiatives in recent months. They discussed other areas of further cooperation and joint work, including a focus on effective systems for establishing and verifying digital identity, and participants also highlighted the importance of ensuring robust consumer protection mechanisms during the pandemic, particularly in light of increased susceptibility to conduct risks, including scams, false and misleading advertising, and inappropriate financial advice. Participants welcomed the implementation of the consumer data right reforms from 1 July 2020. Which I simply ask the question, is there a risk of groupthink here? If everybody is basically sitting around the table and thinking about the issues in the same way, it doesn't surprise me that you only get one set of outcomes and one set of policies. Unfortunately, my belief is that those policies have been myopically applied for at least the last 15 to 20 years, and in fact have been part of the problem, not part of the solution. Unfortunately, I don't think that just providing more debt is the way out of our current crisis. And my worry is that all parties, be they political, be they regulatory, or even the Reserve Bank, are all on the same page. It's just that that page is the wrong page. ASIC has sued Commonwealth Bank and its subsidiary Colonia First State in relation to alleged conflicted remuneration paid by CFSIL to CBA between the 1st of July 2013 and the 30th of June 2019. According to ASIC Deputy Chair Daniel Crennan, the proceedings reflect the ongoing commitment by ASIC's Office of Enforcement to bring the Royal Commission referrals and case studies to litigation when appropriate. In this instance, ASIC alleges that more than $22 million in conflicted remuneration was paid by CFSIL to CBA for the distribution of Essential Super, a superannuation product issued by CFSIL. CBA distributed the Essential Super product using both its branch and digital channels, and approximately 390,000 individuals became members of the super fund under the arrangements. ASIC alleges the arrangement breached the ban on conflicted remuneration, as it could reasonably be expected to influence the choice of financial product recommended by CBA to retail clients or the financial product advice given by CBA to retail clients. As such, ASIC is seeking civil penalties against both CBA and CFSIL, with each contravention attracting a maximum civil penalty of up to $1 million for both of CBA and CFSIL. The first hearing is yet to be listed by the court. Now, on its website, CBA has acknowledged the proceedings by ASIC and says it will provide any further update as required after reviewing the regulator's claim. In June 2018, CBA announced plans to demerge its wealth management and mortgage broking businesses in totality sometime in late 2019. The demerged businesses, called CFS Group, was to include CBA's Colonial First State Global Asset Management, Count Financial, Financial Wisdom, and Aussie Home Loans businesses. However, in March of 2019, CBA announced the temporary suspension of the demerger, but failed to provide an alternative timeline. Colonial First State remains a wholly owned subsidiary of CBA to date. The ACCC says Australians lost over $634 million in scams in 2019, according to the latest figures in its latest Targeting Scams report. There were more than 353,000 combined reports to ScamWatch, other government agencies, and the Big Four banks last year. Unfortunately, it's another year with devastatingly high losses, and scammers are constantly finding new ways to defraud Australians, the ACCC said. This year, we've included data from the Big Four banks, which gives a much more complete picture of how much people are losing to scams. Business email compromise scams accounted for the highest losses in 2019, with Australian business communities and some individuals losing $132 million. The This was followed by investment scams at $126 million and dating and romance scams at $83 million. Over the past 10 years of targeting scams reports, ScamWatch has received almost 1 million reports of scams. When we combine ScamWatch reports with partner data, we see that Australians have reported losing $2.5 billion over that time, which is astonishing, they said. We know these numbers still vastly understate losses, as around 1/3 of people don't report scam losses to anyone, and in the past, far fewer scam reports to other agencies have been captured. Some of these scams can last for months or even years and can leave victims financially and emotionally devastated. Based solely on reports provided to the ACCC in 2019, scams originating on social media increased by 20%, and contacts via mobile phone apps increased by 29%. Over the past decade, scammers have taken advantage of new technologies and current scams to use social media apps and new payment mechanisms that didn't exist in 2009, they said. In particular, a new trend with dating and romance scams is scammers contacting the victim on social media apps or games which are not designed for dating. So it's important to be aware that scammers can target you anywhere. Common techniques that scammers use to manipulate their victims include making exclusive offers that you don't want to miss out on, or asking for small commitments such as completing a survey to make the victim more likely to comply with larger schemes. You can always say no, hang up the phone, or delete an email. Even if you'd said yes previously, you don't owe the scammer anything, they said. And they concluded, if you think you've been the victim of a scam, contact your bank as soon as possible and contact the platform on which you were scammed. And finally, The Hill reported that Anthony Fauci, the administration's top infectious disease doctor, told a House panel on Tuesday that the country's response to the COVID-19 pandemic has been a mixed bag, adding that an increase in cases is disturbing. In some respects, we've done very well, he said during an Energy and Commerce Committee hearing, specifically praising the way New York has been containing the worst outbreak in the country to date. However, in other areas of the country, we are now seeing a disturbing surge of infections that looks like it's a combination. But one of the things is an increase in community spread, and that's something I'm really quite concerned about, he said. There are now about 30,000 new cases per day in the US. The number of new cases had leveled out at around 20,000 and stayed that way for 3 weeks before the past weekend. The rise in the US comes as the Trump administration has sought to paint a rosier picture of the US outlook. Both President Trump and Vice President Pence have inaccurately tried to attribute the increase in cases to more tests being performed. The new spike in the US is being driven in part by worsening outbreaks across the South and Southwest, including Arizona, Texas, Florida, and the Carolinas, even as the situation has greatly improved in once hard-hit states in the Northeast like New York and Massachusetts. Many of the states now being hit hard were on the more aggressive side in reopening their economies. Right now, the next couple of weeks are going to be critical in our ability to address these surges that we're seeing in Florida, in Texas, in Arizona, and in other states, he said. While cases are spiking, the hospitalization and death rates have not been rising, but contrary to what some administration officials have argued, he said it was too early to draw conclusions. Deaths always lag considerably behind cases. You're seeing more cases now while the deaths are going down. The concern is if the cases infect people who wind up getting sick and going to the hospital, it is conceivable you may see the deaths going up. So I think it's too early to say because the deaths are going down, he said. And he said that he understood that young people have a pent-up urge to go out, but urged everyone to wear masks, continue to practice physical distancing, and adhere to the guidelines developed by the Centers for Disease Control and Prevention. And he said even though young people might think they won't get seriously ill from the virus, they could still unknowingly spread it to others. Even though the overwhelming majority then do well, what you can't forget is if you get infected and spread the infection, even though you do not get sick, you are part of the process of the dynamics of an outbreak, he said. What you might be propagating, perhaps innocently, is you infecting someone who infects someone who then infects someone who is vulnerable. And he, along with the other top health officials, made it clear that he believes the virus will continue to be a concern well into the fall and coincide with flu season despite Trump's repeated efforts to downplay the severity of the outbreak. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.